Welcome back to Real Estate 101. Today we're going to continue our discussion on mortgage financing and talk a little bit about refinancing to pay off debt. And I'm pleased to be joined once again by Tracy Brock of Dominion Lending Centers. Tracy, welcome back to the show.
Thank you, Joe.
All right, Tracy. So now that we're past the holiday season, do you have any recommendations to help people manage maybe some debt they accumulated over the holidays?
Well, it's inevitable. You always have a little bit of extra spending at the Christmas time and the holiday time. So, you can look at the equity in your home and see about doing a consolidation loan to see if that's the way to go. A lot of times, the interest that you're going to pay on your new mortgage, even with a penalty, is going to be far outweigh the cost of that credit card debt that you have.
Okay. Now, what is the most that a lender will allow you to refinance in your home equity?
So 80% is usually the standard rule. There are some private lenders out there that will go higher, but to keep, the value of what you're trying to achieve, 80% is typically the maximum that you can take equity out of your home.
And what do you find that is the main reason for your clients who are refinancing?
There's lots of reasons. I mean, they don't only just refinance just to do debt, but, save interest payments, minimize their monthly expenses. When you get all those credit cards, sometimes only paying the minimum payment, you're never really getting anywhere with them. A lot of times you can look at a credit card statement and it'll say
100 years left to pay it off.
100 years left to pay off. If you only pay the minimum payment, you never spend another dime on this credit card, it's going to be 100 years to pay it off. So
Right.
sometimes that kind of gets a fire under their butt, and they say, oh, you know what, I'm going to do something to minimize my monthly expenses. And minimizing monthly expenses helps in the long run altogether, because now you're not worried about that debt. You're not getting the phone calls. It's all taken care of in one monthly payment.
All right. So usually when people refinance, let's say hypothetically, it's because they got, multiple outstanding debts, right? So like you're saying, as opposed to paying multiple, they refinance under one, and they end up saving some money.
That's right.
Every month. So is there an average that you can that you could substantiate that people can save?
It's hard to substantiate an average. I would say that because every person's a little bit different. Somebody who has 50, 60,000 of unsecured debt is going to realize a better savings than somebody who's only got $20,000 or $30,000 worth of debt.
Right.
But I would say that 8 times out of 10, you're reducing your monthly expenses by 50 to 60%.
Wow.
Yeah.
So what do you suggest they do with that? That extra 50, 60%?
Well, it's about budgeting, right? So if you're finding that you're going to start using those credit cards again, maybe that extra money is put towards something that you would have normally spent on your credit card, but now you're going to put that money towards something else. If the credit card debt is circumstantial, such as Christmas, then maybe you start putting extra money on down towards your mortgage, or you put money aside in savings to allow you to, go on a vacation. There's lots of other ways to utilize those extra funds. Maybe those extra funds are just going to give you peace of mind.
Right.
Right.
Now, some people that I talk to, they are under the impression that when you refinance, it ends up extending the life of the loan. It takes longer to pay off. Is that true?
Theoretically, yes, it takes longer to pay off, because typically when you refinance, you increase your amortization again, and you're adding to your mortgage. So obviously the life of your mortgage is being extended just because the payments you're now paying that much more for your mortgage.
Right.
However, it doesn't have to, there's ways to mitigate that. And you can mitigate it by decreasing the amortization when you refinance. You can mitigate it by taking that extra funds that you have now that you were normally putting into credit cards and put it back onto your mortgage. And you can also, when it comes up for renewal, revisit what you're doing with your mortgage when the mortgage comes up for renewal, and maybe at that time you decrease your amortization again. So,
all right. So is the only reason why a homeowner would refinance because they have credit card debt or bad debt?
Absolutely not. There's lots of good reasons to refinance. An investment in another property, a vacation, investment just for investing purposes. Maybe you want to take out some equity in your home and you want to start investing in second mortgages. There's kind of a myth that it's a good thing to be mortgage free, but rates are so low now. Why wouldn't you want to take that money that you have and go and invest it at a higher interest rate? If you can get a rate of return of 8%, or in second mortgages 10 to 12%, what does it matter if you're paying 3% off on your mortgage? It's a big difference. So
Right.
There's other reasons to take out equity in your home, and using a line of credit or just refinancing to reinvest in something else is always an option.
All right. So I understand from talking to people in the industry that not all lenders are doing this. Why is that?
Well, so with the changes on October, well, actually, this would have been more like in November when the changes happened in 2016. The monoline lenders and anybody who bulk insured, it's a little bit of a long-winded question, so I'll try to make it as minimal as possible. But any lender, even though they may not have passed those expenses off to the client, monoline lenders insure their mortgages through CMHC, Genworth, or Canada Guarantees as bulk insurance. Anything less than a down payment, 20%. So if you're putting down 25%, your mortgage is being insured, even if you don't realize that. So it kind of offsets their risk a little bit. So monoline lenders work off of investor money, where banks work off a balance sheet. So balance sheet lenders don't necessarily have to insure all their mortgages because they put it on their balance sheet and they have something to offset it and it's all good. So what's happened is a lot of these monoline lenders don't have investors who have balance sheets. So they've been forced to remove the ability to do refinances from their portfolio. I don't foresee that that's going to be a forever thing. I think that eventually they will work it out and they'll get those investors with the balance sheets, or they'll do something that will allow them to go back into refinancing. But right now, a lot of the monoline lenders are only doing purchases, conventional purchases and high ratio purchases, rental properties, business for self, that kind of stuff. And they're staying away from the refinance part.
Really?
Yeah, I don't want to name any lenders because it changes all the time. It changes all the time, but there are a few that are not. So it's getting a little bit limited to refinance your mortgage and who you can refinance it with right now.
Okay, so for the ones that do refinance, any words for those people?
I think that what you need to be aware of is why you're refinancing. To every 5 years refinance your mortgage because your credit card debt is up. You need to really be concerned about budgeting and what you're doing with your budgets. I think there's a lot of good programs out there that you can look into. Enriched Academy has a program that helps you to learn how to invest.
Right.
I have access to that if anybody needs information on that. And just kind of why. And
going back, if you're refinancing every 5 years because it's bad credit card debt, then you've got other problems.
That's right. Yeah. Like what's causing this? A lot of times it's just circumstantial and sometimes it's habitual. And sometimes once people get to that point and they say, you know what, I don't want to get there again. It's creating a plan of attack and not just using it as a quick fix. Right. So if you can really focus on why you got there, I think that going forward, you're not going to have the same challenges.
All right, Tracy. For people watching and listening who may want to get in touch, how can they reach you?
They can call me directly at 416-788-6207. Visit my website at tracybrock.ca, or they can email me at tbrock@dominionlending.ca.
All right, Tracy, great stuff. Thanks for coming on today's show.
You're welcome.
So there you have it. If you're looking for more information on mortgage financing, get in contact with Tracy Brock of Dominion Lending Centers. Don't forget to subscribe to our YouTube channel, like, comment, and share our videos. I'm Joe. Thanks for watching, and we'll see you next time.